Hey everyone, Emily here. Today we're talking about one of the most interesting IPO stories in Europe. The German human-bionics company Ottobock finally went public in Frankfurt, and this became Germany's biggest market debut in more than a year. Wall Street analysts have already published their first opinions, and many of them are very positive. Let's take a closer look at what they're saying. So first, let's talk about what Ottobock actually does. This company works in several advanced medical technology areas: prosthetics, neuro-orthotics, exoskeletons, and a global network of patient care clinics. In short, Ottobock develops high-tech solutions that help people move better and improve their everyday lives. And the market reacted quickly. Ottobock shares climbed more than 3% on Wednesday. Analysts see the company as one of the strongest and most strategically positioned players in the human bionics sector. Let's start with Deutsche Bank. They began coverage with a buy rating and described Ottobock as the global leader in prosthetic and orthotic mobility solutions. According to their analysis, the company can achieve around 10% revenue growth and 15% adjusted EBITDA growth every year through 2029. They also think the valuation for 2026 looks attractive when compared to the company's growth potential. Deutsche Bank points out another opportunity: consolidation. The patient care market is still very fragmented, and the top 5 players together hold only 19%. So Ottobock has room to expand through acquisitions. Goldman Sachs also started with a buy rating and set a price target of €100. They focus on Ottobock's strong product pipeline. The company expects more than 30 new products or upgrades in 2025 and 2026. Goldman forecasts around 14% core EBITDA growth through 2028 and expects free cash flow to grow at about 18% per year. They believe Ottobock has the potential to improve efficiency, strengthen profitability, and deliver consistent results over time. Jefferies analysts also came in with a buy rating and an €84 target price. They say Ottobock has a long history of innovation and strong leadership in every major B2B category. They expect 8% organic sales growth and steady margin improvement. According to Jefferies, the company could also benefit from small strategic acquisitions, better reimbursement access, and cost advantages from low-cost manufacturing. Kepler Cheuvreux is also optimistic. They started with a buy rating and a target of €86. Kepler describes Ottobock as a company with strong purpose and leadership, and they expect industry-leading growth. Their forecast includes 9% organic sales growth and 18% core EBITDA growth through 2027. They highlight economies of scale, higher contributions from the high-margin B2B division, and the company's strategy to move more production to lower-cost regions. They also suggest that ongoing geopolitical tensions, like the Russia-Ukraine conflict, could increase long-term demand for prosthetics. UBS takes a more cautious approach. They started with a neutral rating and a price target of €74. UBS agrees that Ottobock is the #1 company in the €15 billion human bionics market, but they believe the stock price already reflects much of the optimism. Even with this cautious view, UBS still expects strong numbers, about 8% revenue growth from 2026 to 2030 and 17% net income growth. They also expect the company's debt level to decrease over time as Ottobock balances investments, small acquisitions, and dividends. So when we look at all of this together, one thing is clear: most major banks believe Ottobock is well-positioned for long-term success. The company is a global leader, the industry is growing, and the innovation pipeline is very strong. However, valuation still matters, and UBS reminds investors to keep an eye on how the company executes its long-term strategy. If you found this breakdown helpful and want access to more detailed premium research, early stock ideas, and weekly analysis, you can support me on Patreon at patreon.com/USStockstories. Thanks for watching, and I'll see you in the next video.